HMRC 12-day countdown as people may need to make payments. Many workers and business owners face a looming deadline from His Majesty's Revenue and Customs. The July 31st cutoff affects anyone obligated to make payments on account through self-assessment tax returns. Payments on account represent installments towards your upcoming tax bill, including Class 4 national insurance contributions for the self-employed. Whilst most employees have tax automatically deducted from salaries and pensions via the pay system, those earning from additional sources must file annual tax returns with HMRC. This arrangement helps workers manage tax costs by splitting payments in two, with each installment typically representing half of the previous year's tax liability. The initial payment was required by January 31st, 2025, whilst the second must be settled before midnight on July 31st. Seb Maley, CEO and tax insurance specialist at Kudos, explained, "Missing the payment on account deadline can easily snowball into bigger problems. It goes without saying that compliance is paramount. Firstly, HMRC will charge interest on outstanding tax payments, which, at 8.25%, can rack up quickly. Taxpayers who miss this crucial deadline face penalties, with HMRC reportedly imposing 8.25% interest on overdue tax payments. You also run the risk of being investigated by HMRC. Late payments are one of the many red flags that the tax office looks out for. Because of the low threshold at which a payment on account is due, it impacts millions of taxpayers. Staying on top of your tax obligations and making your payment on account on time is important, not just for peace of mind, but to minimize the risk of being investigated by HMRC. Each installment typically amounts to half of the tax you owed last year. From full-time freelancers and small business owners to the growing number of people with side hustles, many of whom might be new to this way of working, you may still owe additional tax beyond your payments on account. This is referred to as a balancing payment. You can't afford to ignore this deadline. HMRC has more data, information, and tools at its disposal than ever before. Nevertheless, the government clarifies that people in the following two circumstances won't need to make these payments. The amount of tax you owed last year was less than £1,000 last year. You paid more than 80% of the tax you owed outside of self-assessment, for example, through your tax code, or because your bank had already deducted interest on your savings. If you're uncertain about what you owe, examine your self-assessment statement or online account. You can access Gov. UK. How are payments on account worked out? Payments on account are calculated based on your projected earnings, usually using the previous year's income as a guide. Nevertheless, the government emphasizes that if you earn more than projected, you could be entitled to a tax refund if your income is lower than anticipated.